Self-managed super fund is all the hype and is fantastic for some, but certainly not ideal for others. With the super environment being so confusing, a super specialist is the ideal partner to discuss your options. For those who already know what superannuation is, do you really understand what type of superannuation is right for which type of investor? Welcome. This is the Industry Fund, Retail Fund versus SMSF webinar, where our expert will guide you through the superannuation environment. So before we get started, we would like to go over some Zoom features you can utilize during the webinar. We encourage you to submit your questions and comments through the chat and Q&A panel. At the end of our presentation, our expert will be making time to answer your questions. We'll be sending a link to our upcoming events as well. Our chat and Q&A features will be monitored by a marketing team all throughout the webinar. And you can also customize video settings, either full screen and minimized. I'd like now to introduce our presenter today, Ian Fox. Ian is a Modora's director and executive planner who educates and focuses clients on strategies to achieve their goals whilst protecting what is important to them. Recently recognized as the finalist in the Independent Financial Adviser 2018 Excellence Awards for SMS Adviser of the Year, Ian has a holistic, no-nonsense approach to advising clients, taking a wider perspective of client circumstances and financial goals rather than the responding and transacting on each request. With qualifications from CPA, Victor University, Melbourne University, and over 2 decades as a practicing accountant and financial planner, Ian truly has clients' complete financial care covered. Over to you, Ian.
Thank you very much for the introduction there, Stella. Welcome, everybody. Hopefully we get a lot out of today's presentation. I think there is a lot of noise around superannuation. It's certainly one of the areas which governments, when they're trying to recover some funds in the tax system, certainly like to attack the superannuation system, but it does have a lot of good benefits, and realistically it is a lot more simplistic than what people make out. Now, if I just flick across to the next slide, please. Okay, as for any presentation, I have to provide what's called a general advice warning. In this case, I'm not taking any personal circumstances into account. Therefore, none of the advice I'm giving is actually specifically tailored to any of the individuals that may be participating in this seminar. All the information is general, and if you do wish to get some personal advice that is appropriate for you, make sure that you meet up with one of the financial advisors within the Modora's group. We can just go to the next slide, please. Thank you. So, here is an interesting thing. Is all superannuation equal? There are many different types of superannuation. Some of the bigger ones and some of the ones that we need to understand. One is retail. What you're looking at for retail, the banks, for example, they're superannuation funds. Industry funds, which are obviously related to specific industries. Self-managed superannuation funds, which is certainly in Australia one of the biggest growing areas, one of the flavours of the month. And there are actually some other options that we will go through and we'll discuss today. One of the most important things and that we come up against is superannuation itself is not an investment. It is an investment structure. What do I mean by that? I mean you do not invest in superannuation, you invest through superannuation. And it's important to understand, why do we have it and why is it so important? Hopefully as we go through in today's presentation, we'll get a good understanding as to why we actually have superannuation and why it is so important. All right. Simply put, we have superannuation in place to help provide for retirement funding in Australia. we have a growing elderly population, and over time, the cost of paying aged pensions to our population as the mix between young and old changes would be very, very restrictive on the budget. So what we have set up is a very tax-effective structure in superannuation. It allows us to invest for retirement at a tax-cheap rate. So the investments are taxed at 15%. This is whilst we are accumulating our money. And this is an important thing too with superannuation. There are two phases to it, as we'll go through. There is the accumulation phase where we build and build and build, and then there is a pension phase when we draw down. Capital gains tax are only taxed at 10%, as long as the assets are held for over 12 months. Now, in your own name, that can be anything up to 45% plus Medicare surcharge of another 2% for 47%, or capital gains at 50% of that 45%. So you can see that there is quite cheap. But then when we go to the second phase of superannuation, which is when we start paying what we call pensions from them, not to be confused with age pensions, a drawdown after retirement from superannuation is called a pension. The earnings and the payments are tax-free over the age of 60. One of the other benefits is superannuation is not part of your estate planning. It's not part of your normal assets. So we actually do have some flexibility to do some different things with your superannuation when it comes to estate planning. There are, however, restrictions. We don't get all of these benefits without getting some restrictions also attached to them. Any superannuation monies will remain there until a condition of release is met. Currently, the preservation age is 58, which means as long as you have retired or you would like to start what's called a transition to retirement pension, you have to wait till the age of 58. Anyone who was born after the 1st of July 1964, it is 60 before you can start accessing any of your superannuation. Therefore, it may not be suitable for people who need access to their money before the retirement and preservation age. What might this be for? It might be for things like an early retirement. You want to retire at 55 or even 50 if you're lucky enough to be in that position. Or you have other larger goals, like you want to pay for children's education that may cost a couple of $100,000. Then it will not be appropriate structure for that. The reason why these restrictions are in here is to make sure that the focus of superannuation and the investments you're holding in superannuation are to fund your retirement. In Australia, and just to confuse things, we actually have 5 major types of superannuation funds. The first are corporate and public sector. In other words, one's run by large businesses or one's run by governments, whether they be state or federal. We then have, and quite often, particularly the ones in the public sector, are compulsory superannuation funds. The amount of large businesses that now run corporate funds is diminishing, but it's certainly, there is a legacy from probably the 1990s and 1980s where that was a very, very important facet of superannuation. As I said before, we have retail funds, which in essence are your bank type superannuation funds. We have industry funds, which are industry specific, whether they be nursing, whether they be in the building industry, or a whole range of other industries. These are basically unionised funds. We have self-managed superannuation funds. Interesting, self-managed superannuation funds often aren't self-managed. Probably would be better called family superannuation trusts. However, we do call them self-managed superannuation funds, and some people do wish to manage their own money and their own retirement funds. And then we have, these are basically the same thing, called master trusts, administration platforms or investment platforms. These are the sorts of superannuation in this structure in the superannuation environment, whereas if you're working with a financial advisor to try to achieve your goals, we can invest as is needed to achieve your goals with a lot of the benefits of a self-managed superannuation fund, but certainly a lot less onerous from a compliance point of view as a trustee, so you don't have to be quite as involved. And it's a little bit less costly as a self-managed superannuation fund. So there are many different varieties that we have, and determining which one's right for you is entirely dependent upon your circumstances. Let's have a look at retail super funds. Again, these are the bank type superannuation funds. What are some of the advantages we've got here? We have a wide choice of investments. Some even allow for direct share trading. They typically have good website and reporting. The better ones have quite high quality insurance and estate planning options, and many offer spouse splitting and other important functions. However, they do have disadvantages. They are expensive. They're probably the most expensive form of superannuation, particularly once your balance actually gets fairly high or compared to an industry fund when the balance is low. The most important thing to understand is the trustee is the person making a decision on these funds, and it's not you. There is a third party that can make a decision to protect themselves and not help members. You need to make decisions well in advance if you have a retail superannuation fund, and some of the paperwork is actually quite cumbersome, and for things such as paying your pension from your super fund, spouse splitting, and other withdrawals. During that transition to retirement period from the age of 55 to 75, it is inefficient. They are often unitised, which means they actually have the investments and the cash that are going to pay the pensions all combined. They're difficult for some small businesses to work with. And as I said, the unitised distributions in retirement, there is no separation of your investments and your cash. So when you start paying your pensions out, you're going to actually be selling down assets to help in your investments to help pay for that retirement. Now, who are they best for? Those who don't want to be involved in their super, but do need some good life and income protection insurance. Really an important facet that is often overlooked in this country is we are massively underinsured, and understanding that the insurance is there to protect the income whilst you are earning and accumulating and paying for your families growing up. And it's a risk that we are often underinsured for, and these retail super funds do offer some really good products in that. Industry superannuation funds. As I said, they're basically set up for different industries. They're often part of union agreements with employers, often have union electives into their boards, union members elected into the boards. They're generally low cost for balances between 10,000 and 200,000. In fact, they're probably the cheapest option. They have enough investment options for simple accumulation. And if you do not want to be involved too much in your superannuation, keeping in mind though, that your superannuation is actually your building up of assets that will allow you to live a lifestyle in retirement. So if you're not, the question I would ask is why wouldn't you want to be involved? But if you do want to, you don't want to have anything to do with it, these industry funds require minimal attention to your super. Some of the disadvantages, some of this, this is very much a generalisation. They generally are poor administratively. Some of them are quite good, but it depends on what industry fund you're actually in. They don't have a lot of options when it comes to pension, spouse splittings or withdrawals. They don't allow things such as borrowing, which is an important facet I will talk about when we get to our self-managed superannuation funds. Insurance options, they're not only necessarily, it's not only that they're overpriced or unsuitable. What happens is their insurances are often also unitised, which means as well as your pensions reducing your investments because of the not separating cash from investments, the unitised insurances actually drop as you get older. So you're covered for less. So that's why the fees aren't as high, because they actually cover you for less. And the estate planning options are usually very poor. And realistically, the default investments are fairly aggressive. And the other thing with the investments inside the industry funds is they're quite often highly related to the industry in which which the funds pertain to. And so therefore, if you're in a building industry type fund, it's quite often that the investments in there are actually the projects that are being worked on. So not only do you not have diversification with your investments, you can actually have your earnings while you're working tied up in the same place where your retirement assets are supposed to be, investments are building up to fund your retirement, which actually does provide a greater level of risk. And again, as I said, unitised drawings for paying pensions, which means your cash and your investments are not separated to pay your pensions down. They are the best for those who don't want much involvement in their super and are only in the accumulation stage and have low fund values. So particularly for younger people, they are very, very good in the fact that they do provide some good investments at a cheap price, whilst we don't have a large fund value, so your funds are not eaten up by fees. Self-managed superannuation funds. What are some of the advantages? The first one is a controversial one, in my opinion. The more control over the management and investment of super. Unless you have expertise, that actually may not be an advantage and can actually be seen as a disadvantage. So it's one that, yes, you have sort of control, but therefore you also have responsibility as a trustee. You have an access to a broader range of investments and products, strategies, including gearing. Now, this is the important thing. Some people, when their goal is they want to retire at the age of 60, and the bulk of what they have put away for their retirement, even with normal regular contributions into superannuation, will not get them to where they want to go. So what they require is gearing or borrowing. So instead of having, say, $300,000 invested for the 20 years, they can have $500,000-$600,000 invested for the 20 years by using some of a bank's money or gearing. Self-managed super funds are the only structures that actually allow for this. And so it's an important difference. Also, another thing that a self-managed super fund can do that no other type of fund can do, if you're running a business, it does allow for the purchase of that commercial property for businesses. Why is this important? Well, it allows you to actually operate your business in the most efficient way possible, if necessary, by owning the property and actually doing what your business needs are best in that property, not reliant on some landlord to actually tell you how you need to set up, what you can and cannot do in the premises. The other thing is it does actually provide some security too from third parties by owning the property in your self-managed superannuation fund. By having some sort of control over the investments, if you are doing it yourself without the aid of a financial advisor, you do get the advantage of paying less tax by having certain franked type investments in there. The other side as well, if you're having gearing in your superannuation, you also get the tax deductibility of the interest on that gearing as well as the franked dividends. It's ongoing and portable. In other words, no matter where you are working, you can continue to utilise that superannuation fund for your work life. And it does have a greater array of estate planning strategies available, because you actually, as the trustee, working within the limits of the trustee, have a range of options you can set up that you do not have that in any other type of superannuation fund. Why do people establish self-managed superannuation funds? It's an interesting one, and we look at why people actually establish them as self-managed superannuation funds. It is an emotionally driven decision, not an asset driven. And the two things are control. As I said, it's not about the asset management as much as we think. It's an emotional decision, because unless you have pure real expertise on investments, why would you think your asset management would be better than a professional who actually does this for a living? Control over your future, your retirement, and then asset management. It does provide those options, but again, you would need to be working with a professional to do this. Now, whether that be a financial advisor or a solicitor or both, you do get that. Now, flexibility due to the wider range of investment options and availability of more complex estate planning strategies. Again, that is true. That is why people establish it. But should they actually be called self-managed superannuation funds? Because if you're working with somebody, they're not a self-managed fund, but you do get even more benefits of a self-managed super fund. Some of the disadvantages. Now, first one is really critical. Responsibility to ensure the fund complies with the law. If you have a self-managed super fund, you are a trustee, whether you are doing this under advice or by yourself. You are responsible to that fund as a trustee to make sure that you are meeting all of the legislative requirements as a trustee's responsibilities entail. Compliance-related task and management investments can be very time-consuming, particularly if you are doing this yourself. Even if you have someone assisting, whether it be an administration service via your accounting firm, whether it be within a financial advisor or a solicitor, you are still the person who is responsible for making sure it happens. These others are assisting you in making sure that you do remain compliant. There are still now some investments that, well, they used to be, but are no longer allowable or not wisely invested. Things such as a holiday house. People used to put their holiday house in there. You can't do those sorts of things anymore. Or lend money, buy a house or an investment property to put your kids in. Can't do those sorts of things. They're not cost effective for smaller amounts of money. They're not cheap. Whether it be via with a professional working with you, whether it be a financial advisor or solicitor, or just to do the administration. These self-managed super funds are not cheap. They have a number of laws they must comply with and a number of things that must be complied with every year, so they're not cheap. And there are really 2 or 3 different figures you need to look at to make sure that they are cost effective. You do need good advice, and you do need someone taking care of the administration, because there are a number of changes that are happening. Each year, as I said earlier, our governments tend to find superannuation. The superannuation environment is a great area to try and catch up on some lost revenue that they need to fund their next election promise. You need someone on top of all of that, because, again, you're a trustee. It's your responsibility. One of the things is, if you are not the trustee, and there's something goes wrong in the fund, you actually do have the ability to sue that trustee to protect your assets. Well, if you are the trustee, you can't actually sue yourself. So you actually make any mistakes, there is often no recompense or no way you can actually fix or correct that issue. And they cost money. There are significant costs to set them up, and even more significant costs to wind up a self-managed superannuation fund, because they comply. Even if you close it up 2 days after the end of a financial year and the start of a new financial year, an entire year's worth of administration needs to be done after those 2 days. So the costs don't actually drop because of time, because the amount of work involved is actually still the same. So again, be very sure you want a self-managed superannuation fund and it is right for you. What are some of the other advantages? Now, as I alluded to before, asset protection. You hold your commercial property you're working in inside superannuation, it is protected from third parties unless you have done something after an event or knowing of an event. All of the assets that you have in there are protected in that structure. Whereas if they're in your own name, for example, and you are personally sued for whatever reason, if you're growing an investment portfolio, you may need to use those funds to pay off that debt. Your superannuation is protected unless, for example, if you went bankrupt, where they can show the bankruptcy trustee that maybe is looking after your case can show that the main purpose of your contributions after a certain stage is to not pay your creditors, then they can make sure that you may have to pay back those contributions. Cash drawdowns are controlled in retirement, increasing asset protection. In simple English, you actually have a separation. You have an operating bank account that is separate to all of your investments. You can change and modify your portfolio as should be done when you go from accumulation to pension that you cannot do in most other superannuation fund structures. And as I said, the other thing is the best trust structure, or utilising the way you do use borrowing in self-managed superannuation funds. If you do have other defaults in your own name, you do again get other forms of protection that you don't get in any other superannuation structure. There are many issues to consider. Who will control your superannuation on death? As I said, if a great strategy for anybody may be, because we don't have enough in the way of assets, that we do use some gearing, so we're sort of doubling what we've got invested, and over time it's going to grow and grow. The debt will reduce, the assets will grow, and we're going to have a fairly big estate. And quite often our superannuation is actually a bigger estate than our house. Now, superannuation is not caught under your will. So therefore we need to make sure we have binding nominations set up. And then we've got to work out, we can choose what's the most appropriate way to pay it. Do we pay out as a pension or as a lump sum? There are strategies we can utilise because you are the trustee without having to go through a whole range of different rules to reduce or eliminate the death benefit taxes that can be paid on superannuation. And the other thing is you can make sure and you can actually protect the beneficiaries, whoever is a beneficiary of your estate, their death benefit payment. We can make sure that we protect their utilisation and enjoyment of that payment. What are some of the disadvantages? Balances of less than $200,000, the fees can be prohibitive. They certainly are if you want an advisor, if you are doing it with an advisor. We look at around about $250,000 to $300,000 before then maybe start to become cost effective. $200,000 is something that is actually set by ASIC at the moment. It's a random number. It's not, if you do some analysis, it's not always the right thing depending on what the purpose and what you're trying to actually do is. But certainly it is more expensive than other options if it is less than 200,000, and most advisors, well, advisors shouldn't be recommending a self-managed super fund if you do have a balance less than that. If you don't want any regular involvement in the superannuation, trustee obligations can be time consuming. Now, of course, as with anything, we do have other options, which is we get our administration services, or different accounting businesses offer us superannuation administration services to take away a lot of the time that's actually in there. We do have other people like our accountants who put together the tax returns and all those sorts of things, a financial advisor putting together investment strategies, solicitors looking after the binding death benefit nominations and all those documents as well. But that is all time consuming. The other thing is, if you're planning on living overseas for an extended period of time, you cannot be a non-resident and actually be a trustee of a self-managed superannuation fund. Now, I do have a questions come up, which is in the press recently, they talked about it not being cost effective for less than 1 million. It's an interesting thing. In some cases, that is true, but again, a lot of the stuff, and you've got to keep in mind, when the press reports things, you don't actually get to see what they're analysing for and against. If something is cost effective but doesn't actually achieve a result, and you pay less and you don't get to where you want to get to, does that make it cost effective because it's cheaper? And the answer is quite plainly no. It's not. Cost effectiveness is what you pay, will you get to your result? And you can pay less, but if you pay less and still don't achieve your retirement goal, well, you've saved a little bit. Again, focus is, but you don't actually get to do what you're actually trying to do. And it's one of those things that's always a little bit frustrating. A lot of talk in the media about, oh, you know, don't pay this, you should only pay this. Well, that's okay. But if not doing that means you don't actually get to achieve what you want to achieve, has it really been a benefit to you paying less? So realistically, when you do analysis of what you've got and where you want to get to, as I said, it's a case by case. There's no actual number. So I always find an arbitrary figure of 200,000 being interesting, another arbitrary figure of $1 million being interesting. I can quite bluntly say I've got clients who might only have $300,000-400,000, and if they didn't take out a self-managed superannuation fund, would not achieve their result because they won't have the benefits of gearing that will actually provide an injection. So it's an arbitrary figure, and always be careful of the media, because there's quite often knowing who actually put together any report is really important, because there's quite often people getting subsidised by certain industry groups that gives us a different result to what we might think. This is why it's a general concept today. Every person is different, and you need to speak to an advisor to work out, is it right for you or is it not right for you? Because we don't know. What is an SMSF? Now, SMSF is simply just a trust where money and investments are held and managed on behalf of the members. Realistically, the sole purpose is to provide benefits to members on retirement or upon death. There is no other purpose for a self-managed superannuation fund. Its sole purpose is to provide for your retirement. And when you're actually managing your money, you've got to make sure, if you're taking care of the investments themselves, the investments are actually directly related to your retirement. That's why you have investment strategies. The investment strategies are there to help work as a trustee towards what the purpose of the fund actually is. We do overcomplicate it a lot by different product providers and different people trying to flog self-managed superannuation funds. Again, understand what it is, understand why we would do it, and once we've got those two in place, is it right for you? That's a decision that you need to make. And the most important thing is the discussion with your advisors, whoever they may be, making sure that you understand why it is important to you to help you achieve a goal, not that it is a very good thing. What is your goal? What are the other surrounding issues around that? You might have inconsistency with employment, for example, and a self-managed superannuation fund allows a consistent investment methodology that will still assist you to achieve what you need to achieve. The basic requirements is the fund has 1 to 4 members. In the last budget, there was a proposal for up to 6 members. That's more of a benefit if we're wanting to own a business premises or something along those lines to pull more family members' monies. One of the interesting things is the theory behind increasing it is, obviously some families have more than 2 children. They might have 3 or 4 children, so they want to combine all of the monies. But from a pure, if you're looking at it from a control and investment point of view, you can actually end up with conflicting requirements from those investments within superannuation, because you could have members that require a portfolio for retirement, as well as those who are really trying to build and accumulate, and they're all pulled together. So an interesting philosophical change brought in and discussed in the budget that really doesn't meet the basic smell test. Well, what's the reason why we'd actually do it, and does that actually work for what the result is we're trying to get? All members of the self-managed superannuation fund must be trustees and must be capable of being trustees. If we use what's called a corporate trustee, the directors of all of the members must be a director of the trustee company. A single person has the choice of finding a second person as a trustee who is not required to be a member, or simply setting up a corporate or company trustee to fulfill the trustee role. What are your responsibilities as a trustee? Act honestly. Pretty straightforward, that one. Just comply with the law, do things as they're meant to be done. Exercise the same degree of care, skill and diligence as an ordinary prudent person. Keep your fund assets separate. Do not use those fund assets for purposes other than to provide for your retirement or to your family upon death. You need to retain control over the fund. In simple terms, as I said before, you can't say, oh, my accountant who's doing the administration told me I could do this and I could do that. You actually, and you know, they tell me when I've got to do my tax returns. You're the trustee. You've got to tell them. Well, that's what you're saying. As you know, when you take on the responsibility of trustee, that's what you're saying. You got to deal with all parties, both related and non-related, on an arm's length basis. All members, no matter what their balance. This is an important one. All members have equal rights, and that's one of the things I was saying before. Multi-generational SMSFs, they sound good in concept, but there may be people have equal rights, and they actually may have conflicting goals and the conflicting results. So we need to be very careful of that. And this is the most important one. You can outsource, as I said, you can outsource the activities, but the trustee is still responsible, always. What are the costs of getting these things wrong? It's pretty damaging. And this is one of the things why, if people are setting up a self-managed superannuation fund, do not fully understand what control means, what the purpose is. They're doing it because their friend did it and said, look, it's a great idea to go out and do this, this and this. I've been doing it and it worked really well for me. Well, if you get it wrong, there's some really strict actions. You can be removed as a trustee and appoint an acting trustee. Now, that new trustee may not be acting in your best interests. The fund can be closed. The trustees can lose a substantial portion of their funds, plus fines and imprisonment. The roles and responsibilities of trustees are as onerous as those of a director of a company. If the fund is declared non-complying, all of the assets. So if you have $1 million in your superannuation, self-managed superannuation fund, you will lose $450,000 of it to the government. There could be other penalties, and there can be fines of up to $220,000, and you can be imprisoned for up to 5 years. Really important to understand why you need help in working with a self-managed superannuation fund. Yes, it can be cheaper to do things yourself, and yes, it can be more cost effective. But if you get it wrong, what you save, the small dollars you save, could cost you a lot more. So we've had a look at three types of fund: industry versus retail versus self-managed funds. What's the best? Again, there is no such thing as what is the best in general. They're all specific to, well, what is the result you're wanting to get to? What are you wanting to be? What do you actually want, and where do you want to get to? Industry funds are really good for those who don't want any involvement in their super. They're in accumulation stage and have a low fund value. Retail are those who don't want to be involved in the super, but want to have a bigger investment choice than what industries offer. SMSFs, they don't require any of the protections afforded by having an alternate trustee managing their assets, insurance and estate planning outcomes. They wish to maximise the members' super benefits to greater trustee control, strategy flexibility, a wider range of investment choice, comprehensive assets and estate planning, protection and distribution, the potential for reduced product fees for larger balances. And the reason for that is there's usually a flat fee being charged in the self-managed superannuation fund, whereas the others are a percentage-based fee. So therefore, you can actually, the percentages drop as the fund actually as the fund actually grows. So your fees actually become lower as your fund grows. And the other types, again, corporate and public sector funds, the company funds, large company funds aren't as common as they used to be. Before our superannuation system in the early 90s, we got compulsory superannuation guarantee. One of the big things that employers set up for their employees, particularly the ones they wanted to keep, was they set up their own superannuation fund. There was many different types. There were ones called defined benefit, which paid you out a multiple of your retirement salary. There were other ones, and then paid a lifetime pension with the reversion of around 70% going to the spouse. Those funds really, after superannuation grew, became less and less common, particularly defined benefit funds, purely and simply because there's no guarantee that the money was there to actually fund them. Same as in the public sector. A lot of government roles had different types of superannuation funds. The defined benefit ones were always a really generous system, but like in the 90s, when Victoria was actually in a little bit of economic trouble, I think if I remember rightly, it was around about 19 billion unfunded superannuation was sitting on the balance sheet. In other words, the investment wasn't there to actually pay for these people in retirement if they all retired at once by about $19 billion. They still exist, and again, they can still be the best for individual people and their circumstances, and it could be a combination of two. The master trusts, administration platforms, and investment platforms are ones that financial planners use. We tend to use those as opposed to a self-managed superannuation fund, unless there is a compelling reason to use a self-managed superannuation fund. The compelling reason is quite often something, as I said, we need some gearing. Because otherwise, if we don't have the gearing, we have inconsistent income outside of superannuation. If we don't have the gearing, we're actually not going to get to retire when we want to retire, because we don't have enough investments working hard for us to get to that level. Or we do want to buy a commercial property to operate our business out of. Those circumstances, we wouldn't look at using our own platform or along those lines. We would look at using a self-managed superannuation fund. One of the most important things is, and this is really important for any investment, we need to understand this, and it's a really important thing. Superannuation requires a long-term investment focus to help you achieve your retirement lifestyle. We can't wait till the last 5 years and hope it's going to work. People who talk about, the best time to buy, the best time to sell, there is no such thing. It's how long you invest in the market as opposed to trying to produce the time of the market. So in other words, it is the time you have in the investment market is always stronger than trying to pick the timing of the investment market. I just got a little slide coming up next that shows the thought process of the short-term focus. I always enjoy this. And you will talk to those who have a little bit of knowledge in this field, and you'll get to hear all of these things. And you'll get to hear a lot of our so-called media experts that really aren't talk about this. And if we just have a look at the graph, are the prices going up? Let's watch the market. The trend is holding. I'll buy at the next consolidation. We have a little bit of a correction. Damn, I missed a consolidation, but if I wait any longer, I won't profit from the trend. Let's buy now. 4, we've gone up a little bit. Good thing I didn't wait. 5, I'll use this correction to increase my position. 6, brilliant. At this price, let's double it. 7, ouch. As soon as it goes back, I'm selling out. In other words, we're starting to panic. 8, I don't believe it. It's down to 8.25. It's hit an absolute bottom. 9, okay, let's wait for it to recover. Otherwise, this will be a really long-term investment. 10, what's the Australian Stock Exchange doing about this? 11, enough, I'm selling out. 12, good thing I sold everything. 13, it's going to tank again anyway. 14, yep, there it is, I told you so. 15, starting to grow. You what? 16, what the? 17, more crazies who are going to get taken to the cleaners. In other words, why are these people buying now? 18, this is it. I knew this was going to happen all along. 19, drat, I'll buy again. It's cheaper than what it was last time. That sort of investment thought process is something we're very good at, something our media is very good at selling. Here is a simple thing. If we invest well, we invest in the economies of Australia and the world. It is a long-term investment. The risk is a very, very simple one. If we have a diversified, good quality portfolio, the risk is an economy going into a deep recession or a depression. Incidentally, if those things happen and you're in good quality investments, it doesn't really matter where your money is. So keep this in mind when you're making your investment decisions inside superannuation. We finish with a quote from Mahatma Gandhi, the future depends on what you do today. Making sure that you understand, you need to make decisions, you need to speak to people, you need to have someone to work with, unless you are an actual expert in this field, and that's okay. Even then, we still ask people and learn as well. Do we have any further questions? Questions? No one wants to ask anything else? All right, I have another question here. If you're getting close to retirement, how far ahead would you start to move your money into cash or more conservative? Well, for starters, we need to understand what that actually means. Conservative investments, cash is an important thing to fund your retirement. The reason why we like to separate cash from investments is investments are going to continue to grow. The difference is when you're about 3 years out from retirement, you start to rebalance your portfolio a little bit towards the cash, not so much because of its risk factor, because you actually need the cash to fund your actual retirement. And once you get to retirement, it is handy to have around about 2.5 years worth of cash to fund 2.5 years worth of retirement funding. Now, for everyone, that's going to be different. It's not going to be the same because everyone's got different retirement goals and the amount of cash they will actually need in retirement. And by having the cash separated from the investments, if we do have a minor downturn, like a normal correction that we have basically every 4 or 5 years on the market, somewhere between 15 to 20%, you're going to be able to ride that out pretty comfortably. So realistically, it's about 2 to 3 years out, maybe a little bit more if you are wanting to retire on a larger sum of money. Again, most important thing with anything like this, there is no general answer to it. Everybody is different. What does your retirement look like? How much are you needing? Are you wanting to spend any lump sum amounts? Like, for example, you might want to live off $70,000 per year, but the first year you retire, you want another $100,000 for a round the world trip. That will be a different portfolio to someone who has something different. Most importantly, you look and you plan and you regularly meet with an advisor for these reasons, so that there is knowledge there to allow that sort of adjustment to be made when it is the right time. And again, different for everybody. Any further questions at this stage? All right, as there's no further questions, one of the things is, if you, as an attendee, you do get a complimentary initial consultation session with the Medoris executive planner. So if you're on the line, make sure that if you aren't a client or if you haven't actually been working with an advisor, it is well worth at least sitting down and talking to understand what your personal issues are. What is better? What will be the best direction for you? The executive planners at Medoris are fantastic. We're based in Sydney, Brisbane and Melbourne, so we cover a fair part of the country. So make sure that you take us up on that complimentary offer. As a business, we've had 3 decades of experience of a wealth of financial intelligence, integrated service solutions, award-winning client care, one guiding vision in our business. And that is to make the difference to your life so that you experience your lifestyle potential.
Thank you very much for that, Ian. And I think that wraps up today's webinar. Thank you all for your attention today. And for more detail and superannuation offers, register for our upcoming webinar, and we will go more in detail on how to set up SMSF. So if after this event, you will also be receiving the resources, like the presentation, and more about that offer. If there are no more questions, we'll end today with that. Thank you for your attention, and we will see you again in our next webinar. Thank you.